Let me ask you a question that will probably keep you up tonight. What would you do if I told you that 90% of the millionaires I know made their fortune during the worst economic crises in history? Sounds contradictory, doesn't it? But it's absolutely true. And by the end of this conversation, I'll reveal exactly how they did it. Look, I've been investing for over 75 years. I've lived through 14 recessions. 14. And I'll probably see one or two more before I'm done. That's just how the world works. The economy moves in cycles. Expansion and contraction. Boom and bust. It's like the ocean tides. They rise and fall. You can't stop them, but you can definitely prepare for them. And that's what I want to talk to you about today. How to prepare yourself in such a way that when the next recession comes, and it will come, believe me, you don't just survive, you thrive. Most people think recessions are times to hide, to pull back. And I understand that instinct. When things get tough, when the news is terrible, the natural instinct is to protect yourself. But here's what I've learned. Recessions aren't when fortunes are lost. They're when fortunes are made. Think about 2008, the worst recession since the Great Depression. Everyone was terrified. Experienced investors running for the exits. But you know what I did? I wrote an article in the New York Times in October 2008, right in the middle of the chaos, by American. People thought I'd lost my mind, but I saw something they didn't: massive fear. And as I've always said, be fearful when others are greedy, and greedy when others are fearful. So I bought Goldman Sachs, General Electric, Dow Chemical. I put billions to work when everyone else was pulling their money out. The result? Those investments generated billions of dollars. Not because I'm smarter, but because I understood something fundamental. Recessions are sales. They're clearance events for great businesses. Think about it. If your favorite store has everything at 50%, 60%, 70% off, what do? You stock up. You buy more. But with stocks, when everything's on sale during a recession, people do the opposite. They sell, they panic. And that's where the opportunity is. That's where fortunes are made. Now, let me be clear, recessions hurt real people. And if you're not prepared, if you're in debt, they can destroy you financially. That's why strategy is so crucial. So let me explain step by step how I've prepared for decades and how you can too. First strategy. Cash is king during a recession. I know I spend a lot of time explaining how cash loses value to inflation. It's true, but there's a difference between normal times and recession times. When a recession hits, prices fall. Stocks, real estate, everything. And if you have cash, you can buy at discounted prices. But if you already have everything invested, you just watch your portfolio go down. This is what I mean by dry powder. You need ammunition for the opportunity. How much? Minimum 6 months of expenses, and a separate reserve for investing when stocks are cheap. I've always maintained large cash balances at Berkshire for this reason. People criticized, "Warren, you have 100 billion in cash. That's wasteful." But I was waiting for the opportunity. And when 2008 came, I was ready. Now, let me ask you another question that will change your perspective. What do you think is more dangerous during a recession? Having all your money invested, or having it all in cash? Most people say cash, but they're wrong. I'll reveal why in a few minutes, and you'll understand the fatal mistake that destroyed some of the smartest investors I've known. Second strategy. You need to know what you're going to buy before the recession hits. During a recession, emotions run high. If you make decisions under pressure, they'll probably be bad ones. That's why you prepare in advance. Make a list of businesses you'd love to own if they were cheaper. For me, it's always been about quality, great companies, solid balance sheets, competitive advantages. A bad business is a bad business at any price, but a great business at a discount, that's gold. Let me give you an example. American Express in 1963. The salad oil scandal almost destroyed it. The stock plummeted, but I knew the company. I knew their brand was valuable, that the scandal didn't affect the core business. So I invested 40% of my partnership's money in American Express. Everyone thought I was crazy, but I'd done my homework. I knew its value. It was on sale. That investment multiplied many times over decades. But to pull it off, I had to ignore the noise, ignore the fear. Trust my analysis. That's why you need psychological preparation now. Before the recession. Third strategy. Never use borrowed money to invest. Leverage is the enemy. I've seen more people destroyed by this than anything else. Here's what happens. You borrow to buy stocks. Everything goes up. You feel confident. The recession hits. Stocks fall. You get a margin call. You're forced to sell at the worst possible time. You lose everything. Now I'll reveal the answer to my second question. The most dangerous thing isn't having everything in cash or everything invested. The most dangerous thing is having borrowed money. Leverage can annihilate you in a single event. I've never used personal leverage. Never. Berkshire uses very little. It's too risky. Let me tell you about long-term capital management in 1998. Nobel Prize winners on their team. They used massive leverage. When the Russian crisis hit, they almost collapsed the entire financial system. Brilliant people. Sophisticated models. Didn't matter. Leverage destroyed them. Absolute rule. No debt, no leverage. Only invest money you won't need for at least 5 years. Fourth strategy. Smart diversification. People think diversifying means owning hundreds of stocks. That's not diversification, that's confusion. True diversification is owning a handful of great companies in different industries. Maybe 10, 15 companies you truly understand. Businesses you'd be happy to own for 10 years, with solid fundamentals. In different sectors, recessions don't affect everyone equally. Some businesses do well: utilities, consumer staples. People still need electricity, toothpaste, food. A smart strategy. Overweight defensive sectors going into the recession. When cyclicals become cheap, rotate into them. But you maintain stability. During 2008, while banks were collapsing, my holdings in Procter & Gamble, Johnson & Johnson, Coca-Cola kept paying dividends. That stability gave me confidence to buy beaten-down cyclicals. Fifth strategy. Watch the balance sheets. In recessions, companies with lots of debt go bankrupt. Shareholders lose everything. You want companies with solid balance sheets, low debt, plenty of cash. I've seen investors buy cheap stocks that went to zero because the company didn't survive. It's not enough for a business to be good. It must be financially strong. When you make your list, check how much debt, what are the cash flows, can they service their debt if revenues fall 30%? If not, find another company. In recessions, weak companies disappear. Strong ones take market share. You want to own the strong ones, the survivors. During 2008, all banks were suffering, but some had better balance sheets. JP Morgan Chase, for instance, had capital and liquidity. I invested in the strong ones. Some banks failed, but the strong ones survived and emerged stronger. Sixth strategy. Think long term. Decades, not months. Recessions are temporary. They feel permanent, but they're temporary. The economy has grown for 200 years and will keep growing. There will be recessions, but the trend is upward. If you think in decades, recessions are opportunities, not threats. Imagine buying a farm. Good land, fair price. The next year there's a drought. Crops fail. Prices fall 30%. Do you sell at a loss? No. You know the drought is temporary. You wait. That's how you must think about stocks. You're not buying paper, you're buying businesses. If they're good businesses, temporary setbacks don't matter. I bought Coca-Cola in 1988. Since then, tech bubble, financial crisis, pandemic. Did I sell? No, I bought it for the long term. Today it's worth many times what I paid. Because I didn't panic. I thought long term. Ben Graham said, the stock market is a voting machine in the short run, but a weighing machine in the long run. Short term, emotion. Long term, real value. If you're a long-term investor, focus on owning good businesses. Let time do the work. Seventh strategy. Live below your means. Always. If you're living paycheck to paycheck, you can't save, invest, prepare. When the recession comes, you're vulnerable. I've lived in the same house since 1958. I drive a regular car. No yacht, no expensive art. Not because I can't afford them, but because I don't need them. What makes me happy is financial security. Live simply, save aggressively, invest wisely. Do that, and recessions are opportunities, not disasters. Lifestyle inflation is a trap. You get a raise and immediately upgrade your life. Bigger house, nicer car, and you're not saving more, just spending more. The smart move: keep your lifestyle the same and save the difference. That's how you build wealth. I've known people earning hundreds of thousands with nothing saved because they spend it all. When the recession comes, they're in crisis. Don't be that person. Live like you earn half and save the rest. That's how you get financial security. 8th strategy: stay informed. But don't obsess over the news. The media makes money from fear. During recessions, every headline is doom and gloom. If you consume it all day, it'll affect your judgment. I read the news, stay informed, but I focus on fundamentals. What are my businesses doing? What are their earnings? My advice: limit your news consumption. Check once a day, but don't watch financial channels all day. That's a recipe for panic. Trust your preparation, your research, your strategy. Tune out the noise. 9th strategy: understand the difference between price and value. Ben Graham taught me, price is what you pay, value is what you get. During recessions, prices fall a lot, but the underlying value of good businesses doesn't fall as much. There's a gap between price and value. That's your opportunity. Imagine a business earning $10 million a year. In good times, the market values it at $150 million. During a recession, the price falls to $80 or $60 million. Even though it's still earning $10 million, that's the gap. If you buy when the gap is wide, you get extraordinary returns when it closes. That's value investing. That's what I've done my entire career. Recessions create the best opportunities. Train yourself to look past the price. Focus on the value. What is this business worth? What will it earn in 10, 20 years? ***, 10th strategy: don't try to time the recession perfectly. You can't. Nobody can. I can't tell you when it'll start, end, or exactly when to buy. What I can tell you: when stocks are down 30%, 40% when fear is high, that's a good time to buy. You don't need the exact bottom. Trying to hit it is a mistake. You'll wait for the perfect price, and by the time you're sure of the bottom, the market has already recovered. My approach: start buying when things are clearly bad. Buy some. If they go down more, buy more. That way you're averaging in. You're not seeking perfection. You're taking advantage of the sale. ***, 11th strategy: learn from history. Every recession is different, but there are patterns. Study past ones. Great Depression, 1970s, 87 crash, tech bubble, 2008 crisis. Each has lessons. In the Great Depression, those who held cash did well because of deflation. In the 70s, they were destroyed by inflation. Context matters, but core principles remain. Own good businesses. Buy when there's fear. Think long term. Maintain discipline. ***, 12th strategy: have the courage to act. This is where most people fail. They have knowledge, strategy, cash, but when the recession hits, they freeze. They can't buy because it feels terrifying. Prepare yourself mentally in advance. Visualize the recession. Imagine stocks falling, the fear, and imagine yourself staying calm, executing your plan. Practice it mentally. When it happens, it won't be new. You'll know what to do. ***, final strategy: be patient. When you buy during recessions, stocks don't go straight up. They bounce. They might go down more first. That tests your patience. But if you did your homework, you just wait. Recovery comes, always. It's like planting an oak tree. You plant, nurture, but you don't dig it up every week. You just wait. Years later, you have a mighty oak. That's investing in recessions. Now, let me reveal how 90% of the millionaires I know made their fortune. It wasn't luck. It was preparation. They had cash when nobody else did. They had courage when everyone had fear. They had patience when everyone was selling in panic. And above all, they saw what recessions really are, not disasters. But the greatest wealth transfers in history, recessions, are coming. I don't know when, but they're coming. And when the next one arrives, you'll have a choice: panic or preparation. I hope you choose preparation, because right there, precisely there, is where real fortunes are built.